Welcome back. You're watching Stock Picks. Today we unpack Shoprite, Spar and Pick and Pay with Southern Cross Capital's Cobus Potgieter. Cobus, always a pleasure and hello.
Good afternoon. Thanks for having me, Nolatandu.
Fantastic, Cobus. So keen to unpack these retailers with you today. Maybe we can start off by just taking a snapshot of how they've fared over, the last few reporting periods, considering the fact that even if consumers are cash-strapped, they still need to eat.
Yes. One would expect them to be reasonably defensive, but in all, I mean, these are three very unique investment cases, and with unique sort of operational performances over the last 6 months or so. So we had operational updates from all three in the last 2 weeks, which gives us a nice insight. We haven't really had earnings guidance, but we do know sort of top line how they did. Shoprite stellar performance continues to capture market share. 60/60 particularly successful, growing in excess of 60%. Period over period, which is 6 months over the previous comparable 6 month period in the last financial year. Spar, a complete mixed bag, sort of a bang in line local performance off a very weak base, with a poor performance in Switzerland, a horrible performance in Poland, and a decent performance in Ireland and Southwest England. This is off the back of the SAP implementation issues, as well as one or two governance issues that they have suffered. And then Pick and Pay coming out with guidance so horrific that they indicated we need to do a trading statement, which the JSE demands of companies whose earnings differ more than 20% period on period. You need to guide the market that, but they are simply not in a position to even estimate the damage from their horrific operational performance over the last period. So certainly the one with the bleakest outlook of the three, in addition to the announced restructuring in the form of a potential rights issue and the listing of Boxer, which is the one gem inside of Pick and Pay.
I actually want to talk on Pick and Pay because, of course, that, like you're saying, this is the one that caught us most by surprise. We knew, I think last year, at the end of last year, you and I had a conversation about, at least a new leadership and new management there. It seemed at the time, Cobus, that it would be a quicker fix than what we know today.
Yes. So to delve more deeply into this, I mean, they recruited the same CEO from the early 2000s, Sean Summers, when they were in a leading market position and not investing into the business and didn't have an appropriate strategy. And somehow, in the wake of his departure, things have gotten worse. They've lost that dominant market position. We became from the dominant player to the marginal player. And now they're bringing him back off the back of the implementation of his successor's turnaround strategy being a little too painful, or perhaps not successful enough. Even though I think it was a good turnaround strategy, it just simply didn't get enough runway from the board. So it's a difficult situation, and we've seen, frankly, I mean, it's been an amazing yielder forever, and let's be honest, part of that is probably the controlling shareholders, the Ackerman family, who were hungry for dividends. But, ultimately that's a board policy thing. Shoprite, on the other hand, invested heavily into the business, invested early into a modernized, centralized distribution system, invested in tiering their offering as opposed to having a single offering, catering to the underlying market, and investing into new innovations, the likes of 60/60, Fresh X, Unique, all of these OK Urban, these cool pilot projects, which they can afford to throw a bit of money at, and if it sticks, really invest into that. And ultimately, we've seen that happening, that story playing out, and now Pick and Pay are absolutely on the back foot. They can't even sort of fix what they have. Instead of the existing store base, the lack of profitability means they are likely to breach covenants. They have indicated that they've had the covenants waived from their debt holders over the next 12 months, which means that they expect to, not deliver enough EBIT to match, to sort of be able to cover that debt, and having to raise capital from shareholders and by selling potentially the best asset they have, Boxer, which is an amazing growth asset, to try and fix this balance sheet and ultimately restructure and reposition the business onto a more sustainable path.
Since we've heard of this announcement of a possible rights issue and the listing of Box, I think on the day the share price was down about 16%. Since then, we've seen it edge up 3%. I think one day it was up 6%. And I'm not sure what it tells us about what investors are trying to make sense of here. Is it optimism around what could happen if Boxer is listed and being able to, to cash in on that? Or is it, investors saying we're absolutely done with this counter and we don't see what else we can get from it in the short term?
I think the market is still quite optimistic on the outcome here. And I think, as you rightly pointed out, it's about Boxer. So there are sort of numbers floating around the valuation of Boxer, even though we don't have a clear picture. But it could be sort of anything between 15 and 25 billion rand, which is obviously substantial. The problem is Pick n Pay is a bit of a sick owner, right? At this stage, and Boxer is a growth business. It needs a healthy capital base. It needs to be investing into stores. It needs to be expansive, and you can't be expansive on a distressed balance sheet. So that's part of the reason for listing it. Again, this obsession with control. The Ackermans at this stage only own 25% of the economic rights of Pick n Pay, but because of historical reasons, they have over 50% of the voting rights. Now, their intention, in terms of this operational update, is to list Boxer, but retain control. Pick n Pay wishes to retain control, which means that the Ackermans retain control of both Boxer and Pick n Pay, which means that at best they're gonna list 49% of Boxer. The rights issue is only 4 billion rand. That barely fixes the hole in the balance sheet. That doesn't fix Pick n Pay. That certainly doesn't provide enough runway to invest into Boxer down the line. So the turnaround strategy for Pick n Pay and the listing of Boxer and the capital raise, all of these moving parts sort of really need to click together and work out nicely for what I think is the market's current quite optimistic outlook for these businesses. And on that basis, I think there's a lot of downside still in Pick n Pay from this level, because frankly, the management team they have now, I don't have the confidence in to pull this off. Certainly not. Frankly, it's the same guys that got them into this mess in the first place. So, I don't think there's a potential catalyst for an enormous value unlock here, but that is not what is on the table. And what's telling from this update is it's clear that they engaged with the debt holders because there's this concern for breaching of covenants. However, it is not clear that they've engaged the shareholders, because when you announce a rights offer, the practice normally is to announce it as fully underwritten. This was not mentioned here. So we've got no idea whether the Ackermans are following their rights. At a 4 billion rand rights offer, it's going to cost them around 1 billion rand to follow their rights, to retain their proportionate control from where they are at the moment. And we also don't know whether the other holders, the likes of Alan Gray, and the GEPF, who are substantial holders, are supportive of the rights issue in its current form, or whether or not they're going to use this opportunity to extract more concessions in terms of a proper restructure at Pick n Pay, which is something I'm hoping for. I'm hoping that shareholders put their foot down and say, this is enough now. This is a fantastic business. You've been doing a terrible job of managing it. It is time to bring in some fresh blood and fix it. And that way, especially given that they still have this amazing opportunity in Boxer, if it is well managed, there could still be decent execution, but ultimately it's going to take quite a painful capital raise from the market. And I think to justify that painful capital raise, they're going to have to do more around fixing the strategy and fixing the management team.
Well, it sounds like there's still quite a journey ahead of Pick and Pay, Cobus, and all we can do is watch. Another company that I think has endured some issues, it's very possible that they're on the other side of it all, is Spar. They had some serious governance issues, as you've mentioned, but they also had lots of SAP issues, SAP issues. That happens actually to a lot more entities than we think.
I never know whether or not we should call it SAP or SAP.
Yes.
In formal presentations, it's always SAP, but we all know the SAP consultants, right? But anyway, so that implementation was disastrous. As part of the management shuffle we saw before, which was more to do with a chairman and a CEO who also owned franchises and were accused of discriminating against the underlying franchisees. So that had to get resolved, and that governance outcome has been very positive. But that same board, it seems, at least from fairly decent investigative journalism done by some of the more reputable financial publications, including ones tied to yourselves, have seem to have found evidence that the board ignored the warnings around the SAP implementation. That didn't really have the necessary expertise to oversee it. And as part of that reshuffle, sort of right in the wake of that initial governance reshuffle, we saw that the board being strengthened around SAP implementation as well. That still hounds them. KZN in particular, it seems that both Pick and Pay and Spar are bleeding significant market share in that in KZN specifically. So that, in terms of the local businesses, has been an own goal for them. Off the back of Pick and Pay's weakness, they should have been benefiting massively, and that certainly hasn't been the case in that region. In Switzerland, they're suffering from a very tough inflationary environment, and as we know, Switzerland's got its own sort of unique situation. The Swiss franc's almost like a gold, a safe haven asset, and the currency appreciation there has become entirely unsustainable, to the point where the cost of living there is so high that people are driving across the border to do their shopping in France over the weekends, and that's hurting Spar in Switzerland. And then Poland's just a mess. So the two major catalysts for Spar Unlock, and it is quite cheap at the moment. I do think they'll push through this. It's really difficult to have this conversation and sort of have to discuss whether or not we're going to have a Spar, whether or not we're going to have a Pick and Pay in 5 years' time. That's quite tragic. It is a tough environment at the moment, load shedding, all the rest, and then you go and score some own goals. But the two major own goals here, which is Poland and the SAP implementation, Poland needs to be sold, and they are actively trying to do that. We had some optimism that there are set of results. Not any decent guidance in the latest update, but if they sell that, that'll be an enormous catalyst. Just get out of that market. And then, of course, rolling out the SAP implementation, fixing that, and bouncing back off that weak implementation. And of course, recapturing that market share amongst your own franchisees, because the acquisitions and distribution system was flawed, and the franchisees were forced to look elsewhere to source goods. They can't just stop selling something because you can't supply it to them. So they went and sourced alternative sources for those. So you've got to recapture that market share from your own franchisees. So there is some upside there, and ultimately I think they'll get through that. So I think Spar is that's quite an attractive turnaround play at its current valuation, and it is still a very robust, very, very decent business. We just need to get rid of that balance sheet stress being caused by Poland.
Let's talk about Shoprite now, because they've had a completely different period, a completely different era here. They've seen record revenues. I think they recently just secured about 1 billion rand from Standard Bank to even strengthen their supply chain. It tells us that Shoprite is doing just fine.
It's not whether or not they're going to do well, it's how well they're going to do. And the execution in supermarkets SA is absolutely phenomenal. In time, it's been demonstrated that the sort of tiered approach to the offering has worked very well. They've gone and made that more unique with Fresh X, which is these sort of you know, you walk into some of the nicest checkers, and it's just such a fantastic experience. You know, specifically packaged foods and fresh goods. It's such an upmarket field, still reasonably priced. And then the major recent win, of course, is 60/60. And I don't think we realized how much headroom there still was, because in the previous period they'd only rolled it out to the to the 100 biggest stores. If you go even deeper by now, they would have had a lot more penetration in terms of bedding down that infrastructure. And the growth in 60/60 is incredible. And the branding around it just works. You know, it's a standardized offering. The other guys are coming to the fore, but it's not standardized. It's sort of more like an Uber, where anybody can deliver for Pick and Pay. It's not these iconic little motorcycles that are even becoming figurines now. So their implementation has been fantastic. And I mean, just for context, Pick and Pay is trying to raise 4 billion rand to fix the balance sheet as it is. 4 billion rand is significantly south of what Shoprite invests into their business in a single year. In a single year, they invest more than that into the business. They keep plowing money back into it. So it's quite expensive, but it's such a quality stock, and you just don't see the competition being able to react to how well these guys are executing. It's so flippin' well managed. And on that basis, it is certainly my favorite of the three, and I have that in my portfolio.
Yes, and I mean, I take it that Spar would be number 2, and right now Pick and Pay number 3.
Yes, as things stand, absolutely.
And with that said, in the educational segment today, rights issue, it's the big one for this sector right now, isn't it?
Yes. So rights issues are a form of secondary offering. Essentially, a company gets to offer more shares, and it's considered more equitable. What's nice is it affords current shareholders the first rights of refusal in terms of participating in that capital process, which is scarcer than you would think. The typical practice we've seen from the likes of the REITs is to just sell more shares into the market and then make it only institutional investors, and you as a long-suffering shareholder don't get access to that discounted share, and you get diluted away in the process. Where our rights issue works is the rights themselves have value. So for a 2-week period, say you do 10 per 100 rights issue. So for every 100 shares you own, you receive 10 rights. You have the right to exercise those shares, those rights, to convert them to shares at a discounted price. So say 80 Rand instead of the normal 100 Rand that the share is trading at. So the implied value of that rights is 20 Rand. Now, you don't have to follow it. You have the option to follow it. But if you don't want to, that right is listed for 2 weeks as a separate instrument on the JSE, and you can either sell it, you can exercise it, or if you like the story, you can buy more rights. So assuming there's a bit of an arbitrage here, you know, I could buy my right for 19 and exercise it and pick up the stock for 99 Rand all in instead of the 100 it's trading at, that kind of thing. So it's a form of capital raising, secondary equity issuance that is considered quite equitable in terms of supporting your existing shareholder base and getting your existing shareholder base to support you. And where people do substantial secondary offerings, like what we're expecting here with Pick and Pay, it's around 30%, 20% of market share that they're trying to raise. You can't just do a general issuance for that kind of that level of dilution. This is normally the path that we would take in terms of raising that capital, but it creates really nice market dynamics because suddenly you've got multiple entry points into the company and you've got all of these options as a shareholder. So it's quite noisy if you're in the markets, but it's a lovely way to get into a stock at a discount.
Well, Cobus, I do believe that you and I will be speaking about rights issues well into this year. Thank you so much for your time. It's always a pleasure having you on Stock Picks. That was Cobus Potgieter from Southern Cross Capital.